Okay, so this class is extremely important, not just for your principles and understanding the principles of buying and selling a home with a mortgage or with cash or whatever the case may be, but also because you're going to need to know this for your practice, especially those of you who are going to be doing mortgages on the side or doing mortgages. And we're going to talk about mortgages and other finance things that you need to know with regards to loans, okay? So please pay attention, grab a piece of paper, we're in for a ride. Okay, this is the practice part. Every time somebody says to you, oh, what is your name? Hi, my name is. And what do you do? Oh, I'm a real estate professional. How's the market? The answer is always absolutely beeping wonderful. I'm busy as hell. And oh, by the way, it's a great time to buy a home. Why? Because the TV news is always telling them you need a big down payment to buy a home. 100% incorrect. It's a total lie. Lie, 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 lie. Okay? There are loan programs out there for every first-time home buyer. I've used them for my clients. There are state programs and all that kind of stuff. We're going to talk about it. The other thing is, almost everybody thinks their credit is bad. And the fact of the matter is the average credit score right now in the United States is 660. And there's a misconception out there promoted by businesses such as Credit Karma, which is not a credit service agency. They sell credit cards. And you need to understand that their business is to tell you that your score is too low. So you need more credit cards, which, by the way, drives down your credit score, okay? So have a lender, the mortgage broker, run the buyer's credit, and I guarantee you in most cases they're able to buy right now, and if they're not, it's usually because they only have one or two small issues that could be fixed in 30 days, okay? Buyers think that they don't qualify for government assistance because they make too much money. Absolutely false. You can make $120,000 a year with a family of four and still get some type of loan program, okay? The fact of the matter is, and I want you to tell this to everybody you meet, if you have a 401k, you can use it for down payment with no tax consequences, and your 640 FICO score, which is pretty damn low, okay, a pulse and a willingness to do whatever it takes to buy a house, a condo, an income property, you can do it, okay? You just got to convince yourself to get out of that comfort zone and go out and do it, okay? A conventional loan is pretty obvious. It's a amortized loan. The client is putting some kind of down payment. It could be 3, it could be 5, it could be 10, it could be 20, it could be more than that if they want to get the lowest principal and interest rate, okay? A fixed rate mortgage is almost always what is used, and that could be anywhere between 10 to 30 years. The standard 80-20 conventional loan, and yes, 80-20 is a term that we do use, that's where they're putting 20% down, but they're mortgaging 80%. This is your Cadillac client. These are the easy loans to get because they're not paying any private mortgage insurance, and also they don't go through nearly as much underwriting issues with less money down, okay? There's also an 80-10-10. They put 10% down and they get a second loan for 10%. It's usually 1 to 3% higher than the first loan. This is pretty common for people who want to avoid paying the private mortgage insurance. There is a 15% down duplex loan currently required. I've heard rumors that you could do 10 if it actually debt services, if the rents cover the mortgage. A 595 conventional loan is very, very popular because the loan program may avoid the private mortgage insurance, which is a couple extra $100 a month, and it also may also allow you to get more of the benefits of conventional if the property is kind of a fixer and we're worried about whether or not FHA appraisal will pass. you may want to do this program, because if you just come up with the money, now you can beat out all those FHA buyers who are trying to buy a property, and you go to the head of the class in terms of the type of buyer you want, okay? Sometimes the seller will carry back like a 10% second loan if they think that it's worth it. This is going to be a savvy investor who has an income property who's willing to do so. The loan origination fee is going to be on your state exam, and what it is, it covers the administrative cost of making the real estate loan happen, okay? There's quite a bit of work that goes into it, and the fact of the matter is that on VA and FHA loans, you're going to pay 1% of the loan. Now on some conventionals, the sky's the limit. It just depends on how hard it is for the mortgage broker to get the loan through. The more work they have to do, the more they're going to charge, and that's reasonable, okay? The other thing that a lot of people don't understand is that there are areas of secondary financing. It could be a seller carryback where they'll act as the bank. Sometimes you can get a lender to do an extra 10% down at a much higher interest rate to make this deal work. It just depends on the creativity of the mortgage broker and also whether or not the client is willing to listen. And what private mortgage insurance is a complete waste of money. This was created to protect Wall Street if you should default on the loan. The problem is that PMI, private mortgage insurance, is basically like your car insurance. You probably are never going to need it. And if you do, you'll be lucky to get anything out of it, okay? And I personally, this is my personal feeling, this is one of the biggest scams right now, is you're paying hundreds of dollars in private mortgage insurance, and really it's just money out the door into somebody's investment account, okay? It's money that you should be investing instead. So if you can avoid PMI, try. FHA programs, there is a 203B. This is a down payment of 3.5%. Grandma can give you the money if you want. Nonprofit gifts or state programs, pension programs, other sources of funding are acceptable. 1 to 4 units is acceptable as well, as long as you live there, and they must be within 50 miles of your job. So if it's 60 miles away and it's a 4-unit building, you're saying, well, I'm going to live there and drive 2 hours one way. Yeah, they're going to ask questions, okay? They need a FICO score of 595 or better, which is nothing, okay? The other thing is too, so I've had a teacher get money from the school district of LA for their down payment for these programs because she wanted to work in an inner city school. She did at that point. I've seen professors get their pension fund to give them money because they're teaching at an underprivileged university. And I've seen a police department give a widower and his kids because the wife was a police officer and killed in the line of duty. So there are ways to get that 3.5% down. Even state programs will give that to a first-time home buyer. A 203K is the same type of loan, but what happens is this is for a fixer-upper. If the appraiser goes, they send in a special construction general contractor appraiser, somebody who's very familiar with building things, okay? And what happens is, it sounds great, but the home plus the repairs cost, the estimate that it's going to cost to repair the property and bring it up to code, cannot exceed the total value of the house in the neighborhood. So if the value of the properties in the neighborhood are $1 million and the buyers bought it for $900,000, but it needs $120,000 of repair, it's no deal, okay? So this is great for buyers who are very handy. And this you should know when you do those interview questions. You know, one of my favorite questions is, okay, who's the handyman and who will kill themselves with a feather duster? And they laugh and they giggle and stuff like that. And almost always, one or the other is of the partners buying the home will be really handy with fixing up stuff. You know, they could paint, they could do carpet, they watch YouTube videos about it. Not the, the stuff you see on TV. It's all fake. But the other thing is too, if they say we don't know anything. However, we have uncles who are carpenters, electricians, and stuff like that. Great. So let's look at this. If we see something that may qualify for FHA but needs some work, let's see if we can do this loan to get it all paid for. Okay? FHA loans are the easiest to qualify for. You could have had a bankruptcy a year ago. Closing costs can sometimes be rolled into the loan, so you don't even have to come up with that. A lot of sellers will help first-time buyers out by paying the closing costs for the buyer. There's no prepayment penalty for FHA or VA loans. In regards to VA loans, if you have a veteran who has served our country, God love them, they deserve everything they can get. Because trust me, they've seen things that you and I don't want to see. All right? So be very gentle with them. They're great buyers. They first have to get the certificate of eligibility, and I guarantee you they already probably have it in hand, and they're just looking for a broker and an agent who's willing to help them. All right? The thing is that one of the things you must know about VA loans, yes, you can buy up to 4 units, but the VA loan will require the veteran to live in the property, whether it be a condo, a house, or a 4-unit building, the entirety of the VA loan and the ownership of the property. And they will check. They'll check utility records, they'll go knock on the door and stuff like that, okay? They want to make sure that they are giving this benefit to the veterans and it's being used properly, okay? So if you have a buyer who wants to buy a property and the old owner, the owner currently in possession of the property, they have a loan that's an FHA loan, it's assumable, and they usually have a really low interest rate. So what I would do is find out if your loan is assumable on the property that you are looking at as a buyer agent, and see if the lender will allow you to assume the loan. That way you only have to get a second loan for the difference, okay? The other is an alienation clause, okay? And this is a mortgage restricting the seller from transferring title or loan of the property. If you are transferring the property into a trust or into an LLC during escrow, and it is clear to the bank that you're still using your credit and income, they are okay. However, if after you decide to transfer everything, they may ask questions and call the loan, all right? Because you can't just give it to somebody else who's paying the loan. If it's a personal trust, which everybody should have a trust and everybody should own all their properties and businesses and LLCs, never in their name. That's another video. If it is going into a trust, they don't ask any questions because it's still in your credit and you're paying the bill. But you can't just transfer it to somebody else and just walk away. They'll call the loan immediately, okay? And calling the loan, that balance is entirely due immediately. A wraparound mortgage, they're rare, but they do happen. It's where a loan mortgage will be responsible for the current mortgage while you go find your replacement property. This happens a lot when people are moving out of state. So the mortgage will be approved for Texas. The California couple says, oh my God, we're qualified in Texas, but what about our mortgage here? We have to move by a certain date while we're in escrow. It's called a wraparound mortgage. The lender there will handle the mortgage here and cover it and pay it off while you close escrow and move to the new Texas property, okay? It's a higher interest rate, but it allows people who are transitioning to get out of a bad situation that may cause them a lot of headache. A land contract, the seller retains the title legally until the buyer makes all of the payments. The property must be free and clear of all loans. And the seller can choose the down payment, interest rate, and terms. No other financing or loans can take place until the buyer does pay off the entire land contract. So a contract subject to takes over the existing seller mortgage. Buyer does not get the deed or title until the property contract is paid in full. If the seller defaults in the loan, does not make the payments made by the buyer loses everything. The seller remains liable for the payments. If the bank discovers this situation, they may take action against all parties if there is an alienation clause. So some of the programs that you can use, I've used CalHFA, California Housing Down Payment Assistance Program, for several buyers, veteran and non-veteran, and boy, I tell you, this is a great program. They want people to own homes in California. They do not want them to rent, and this is a great program. There are some income restrictions depending on the type of program. There's about 6 to 8 different programs at any given moment, okay? So consult your mortgage broker that you work with out of your brokerage and find out what these programs are entailed. This is a great way to go door knock on apartment buildings and find buyers who want to buy, but they just don't have money for a down payment. The other is Cal Access. It's the same kind of program from the CalHFA, but it's only 2% down, and the Cal Access will provide the other 1%. And it must be owner occupied, okay? Oh, and by the way, no income properties, unfortunately. You can't do a duplex, triplex, or fourplex. And this goes to what you have to tell your client. As you can see from the poor guy up here when he found out what his client did. These are the things you do not want your clients, the buyers, to do just before buying a home or during escrow. And trust me, I could tell you horror story after horror story after, oh my God, horror story, okay? First off, do not change your job 1 year before buying a house. Okay? The bank will you changed your job? It's the same industry? No, I'm an engineer now. I used to work at Starbucks. They will want an explanation before approving the loan. Okay? Do not make any large purchases, such as a car or furniture, during escrow. They will find out. You wait until you get those damn keys before you can do anything, okay? Yes, you can go window shopping for new furniture for your new home, Mr. Buyer. Don't buy anything yet, okay? Do not use your credit cards excessively or make a late payment, because it will kill the deal. Unless, let's say, Johnny falls down, breaks his arm, and you use the credit card for emergency reasons. You can write a letter and they'll explain the situation, maybe even attach a couple of hospital invoices and stuff, and the bank will oh, okay, that's fine. Do not omit debts and liabilities, especially things like child support. Yep, you got to put that on there. If you don't and they find out, they'll just cancel the deal. They don't care, okay? And then number 1, I realize that in certain cultures, it is very common to co-sign for family members, okay? Maybe they don't have a social security number, or you're trying to buy something together, like a car that everybody can use. Don't do it. When you co-sign for someone, those payments are reflected on your income, whether you're making the payment or not. And it could detrimentally affect your ability to actually get qualified to buy a home, okay? So next time what we'll do is, one of the things that I'll do is I'm going to do it on the board next, is I'm going to do a how to value a property when you're meeting a seller, and also how to value a property when you're talking to a buyer about how much you should write the offer for. Thanks for listening. Let's go on to the next one.